Welcome back. Well, as I mentioned, we have Jerry here on behalf of Pacific Financial Planners. Welcome back. How are you?
I'm doing great, Lisa, but I'm really happy for you. Congratulations on your retirement.
Yeah, my semi-retirement.
That's awesome. And thank you for all you've done for me and our clients and allowing us to educate them, on your program.
Thank you very much. Thank you. And you've hit it right on. What is it? The nail.
The nail on the head.
Yes. Yeah. Something like that. Because that's what it's about, is education, right? And you've been educating our community for a while now with your forums and all of your advice. And today is no different. So we're going to talk a little bit about how unpredictable the markets are. But things seem a little better.
Yeah, the inflation numbers came out today, 4%, which is down from 9.5% about a year ago.
Yeah.
Still double over the last 3 or 4 years, but it's heading in the right direction. Mm-hmm. And so that should make things a little bit better. It'll cause probably the Fed, who is meeting today and tomorrow, to not raise rates maybe anymore. We might have peaked out on interest rates.
Okay.
Certainly on the longer end of the market. And those are all good things, positive for stocks, positive for bonds, because a lot of people held bond funds, et cetera. Mm-hmm. So things are looking better, I believe.
Okay, well that's good. And now you mentioned the inflation rate has changed, but we talked a little bit before the cameras came on, is about perception. And so what do we need to keep into mind about perception?
Well, the thing is, Lisa, is that people don't understand the markets because they're unpredictable. So there's a perception by the masses, by the institutions, by investors of what's going to happen. Mm-hmm. So it's been recession, right? All year long, everybody's talking about the coming recession. And I kind of said, geez, I would think we might have had the recession last year, and not all recessions are built the same. The other perception is that the recession is going to be like it was in 2000 to 2003. It was pretty nasty. Mm-hmm. Or 2007 to 2009, which was even nastier.
Right.
And not all recessions are the same. Sometimes it's just a slowdown and you muddle through. I was reading an article that says seniors, the baby boom generation and I guess they're calling it whatever the great generation that was before 1946. That they're spending money and able to travel and doing things, mm-hmm. but yet the millennials and the Gen X and certainly the younger folks aren't, because they're still muddling through it. So again, Perception is your reality, so to speak.
Right.
But the stock market doesn't work in perception or reality. When earnings come out or things like this inflation number comes out, then suddenly it kind of resets the new perception going forward, mm-hmm. and it's that difference is where the market is, and that's why it's so unpredictable.
Okay. So when we talk about different types of things that we should look into and what to invest, you always want to manage your risk, right? And I know that that's one thing that you always talked about, is managing risks, not to lose money like you would lose in the stock market.
Correct. The stock market is somewhat like a casino. A lot of people call it that. And that's if you're buying and holding. I mean, I think that's outdated. I mean, look at companies like General Motors. In the 50s, 60s, even into the 70s, they were the largest employer in America. It said, as General Motors goes, so goes the economy. Well, in 2009, they went to zero. Everyone who was a long-term investor, I'm in it for the long term, they lost all their money. But that wasn't the only one. Eastman Kodak, we make film. How'd that work out for them? General Electric, Xerox, company after company that are big time. If you go back 100 years, it was the railroad industry.
Right.
That all went down. Now the railroads are good now, but there was a period of time in the 60s and 70s they were just dilapidated railroads. Nobody was using it because we had trucking and boats and planes and things like that to get our shipping around. Right. So it really comes down to, how do you achieve safety? And that's through managing your risk.
Right.
By saying, okay, I want to invest in something, but I don't want to lose. So if you're taking risk investments, you don't want to lose much.
Right.
And there's non-risk investments that you don't have to lose at all. And you have to take control of your risk to be successful today.
And one thing that you were mentioning is all these different things that have happened over time. And we could just look back a few years, and if you're not paying attention, things can certainly just go right by you, and that's where you would lose money, and you wouldn't even realize that you were losing money unless you were aware of a variety of things that are going on. Now, I know people who check their accounts daily, And then there's others who don't check for months.
Or ever.
Or ever, right? And so then you would be
Especially
so
at bad times.
well, you would be so clueless, right? Because you wouldn't know what's going on. So when you have people who are not paying attention, what do you tell them?
Well, change is the only certainty out there. We're gonna change. Everybody knows, we change all the time, physically, emotionally, the markets, the economy, COVID, now inflation, now we're losing the inflation, it's getting better. So if people will marry their portfolios, I love this stock, or I love this mutual fund, or what have you, and they don't understand that as things change, as you go into a recession or come out of a recession, you're going to have different types of strategies. Going into a recession, you want big, huge U.S. companies that are slow to change. Coming out of recession, you want small, dynamic, little companies that can change quickly.
Right.
And so you've got to change with the times. There's times to be in the market. There's times to be out of the market. And things like stocks and bond funds have risk because you have no defined outcome.
Right.
You don't know how they're going to work out. And to say that we're in it for the long term and long term stocks go up, well, long term the indices go up because they keep changing the names, but not all companies make it. Where if you look at bond and bond-like instruments that have a defined income attached to it, some are guaranteed, like treasury bonds, things like that. They offer you a guaranteed rate. Or if it's corporate bonds, the corporation guarantees it. There's an implied guarantee with, let's say, preferred stocks, but regular stocks and mutual funds, they don't have any guarantees.
Right.
So, people look at how can I manage my risk? Well, look at things that have defined outcomes, and then you're going to manage your risk that way. If you have an undefined outcome, a stock or a bond fund, it's not predictable, as we talked about. It's kind of the greater fool theory. I'm going to buy it at one price and sell it to somebody else at a greater price than I bought today. Where if you have that income coming in, as you know, here you are going into semi-retirement. So what are you going to do? You got to replace the income.
Right.
How do you do that? You buy things that pay income, that pay dividends, that are safe, secure, and that's the way you manage your risk.
And one thing that we've talked about before is annuities, and I know that those are fairly secure.
The insurance company is backing them, and people go, well, geez, what about them? Insurance companies are reinsured by other insurance companies. Annuities have been around for literally hundreds of years, and then they're backed by the state guarantee fund. So there is safety associated with those, and if you buy the higher rated insurance companies. Now, there is one type of annuity called a variable annuity, and those are the ones you hear on TV, people saying, oh gosh, I would never buy an annuity, they're high in fees. Yeah, they are. Variables. But there's so many other kinds. There's immediate annuities, fixed annuities, index annuities.
Right.
No fees, okay? There aren't any fees, just like your bank doesn't charge you a fee. People go, how can they do that? Well, does your bank charge you a fee? They're making money on your money, and your money's guaranteed, fully insured.
Right, and so that's good to know, because I think a lot of people may be looking for safety somewhere, and that's certainly an option for them.
Well, certainly, our listeners here, in the village, as you get older, as you get to retirement and you change careers, et cetera, that's what you want. You want to have something that's predictable, something that you know. So that's the total return comes from income or growth, with growth being unpredictable, but the income is predictable. Annuities, bonds, preferreds, REITs, real estate investment trusts, those things, you have senior housing. You think senior housing is going to continue? Absolutely. You look at the demographics, more and more people are moving into places like here in the village.
Exactly.
And the rents, 90% pass through to you and the investor.
Yeah.
Good stuff.
Good stuff. All right, excellent. Now, you are going to have a financial forum this Thursday.
Yeah.
That is coming up in 2 days. And of course, you've been having these regularly. All been good?
Excellent. Yeah, we get a lot of people. Look, here's the thing. It's a safe place to come and not only just hear me speak about a subject. This time we're going to talk about a variety of things. Again, mostly about income and safety.
Okay.
And Social Security for those who are younger that haven't, applied for it yet.
Yes.
We'll talk a little bit about that.
Good.
Because Social Security decision is usually $1 million decision. People don't realize it. Social Security, I'm going to get $2,000 a month. We'll do the math. Times 12 months, times 25 years.
Right.
Talking about $1 million decision, especially if you're a married couple, then you're well over that.
Yeah, and you do have to, and there's a lot of changes that are going on, and there's a lot of talk about changes too. So if you want to go to this particular forum, and you can even learn about annuities or ask questions about any type of investment, you can just call Letty, 949-461-5882 if you have any questions. Otherwise, you can just show up at the clubhouse. Thank you.
Congratulations
Thank you.
again.
Thank you very
for all
much.
you've done.
All right. And if you want more information about anything that we have discussed, you can go to pfpinvest.com or call 949-219-0692. We'll be right back.